Imagine a company that is currently just dominating the United States beer market.
Right.
I mean, stealing customers from every major competitor and putting up massive cash flow numbers.
Yeah, the kind of numbers you love to see.
Exactly. But now imagine another company whose wine and spirit sales just plummeted by over 50% in a single year.
Just completely fallen off a cliff.
Right, watching its shipping volumes just tank. What if I told you they're the exact same company,
It's wild.
operating under the exact same corporate roof? Well, welcome to this deep dive. Today we are unpacking the fiscal 2026 and fourth quarter financial results for Constellation Brands, which were just released on April 8th, 2026.
It is honestly a really remarkable document to analyze. You rarely see such extreme internal contradictions within a single, highly successful enterprise.
Yeah, you really don't.
We're basically looking at a masterclass in how a multi-billion-dollar beverage giant navigates what their management calls a dynamic operating environment.
Which, is just a polite corporate way of saying unpredictable, choppy economic waters.
Exactly. The weather is rough.
So our mission today is to decode how this machine actually operates when that weather gets rough. We want to look way past those top-line revenue numbers to uncover the real mechanics of their strategy.
Because that jarring contrast,
Yeah, the booming beer business sitting right next to a collapsing wine division.
it demands an explanation.
It really does. Okay, let's unpack this. I mean, where do we even start when the data is pulling in two completely different directions?
Well, we start at the bedrock.
Right.
Before we analyze the performance of a single bottle of beer or, a glass of wine, we have to look at the ultimate scorecard for any business operating in uncertain times.
Which is?
Cash flow and capital discipline. In a volatile economy, like we're in, revenue is vanity, but cash is reality.
Oh, that makes a lot of sense. I mean, if the foundation of the house is crumbling, it really doesn't matter how nice the paint job looks in the kitchen.
Precisely. And we see that foundation really clearly in their fiscal 2026 numbers.
Okay, lay 'em on me.
Despite all the macroeconomic headwinds like inflation, supply chain quirks, shifting consumer habits, Constellation delivered a comparable earnings per share, or EPS, of $11.82.
Wait, let's translate that for a second.
Sure.
Whenever I read comparable EPS, I always assume we're stripping out the weird one-time accounting noise, right?
Exactly.
Like, we're ignoring things like the sale of a random factory or a one-time tax write-off and just looking at the true recurring heartbeat of the company's profitability.
That is spot on. It basically gives investors the clearest picture of everyday operational health. And the heartbeat here, it's exceptionally strong.
Yeah.
They generated a massive $2.7 billion in operating cash flow.
Wow.
And even more telling, they reported $1.8 billion in free cash flow.
Okay, I always like to distinguish between those two.
Which is an important distinction.
Right, because operating cash flow is the raw money coming in the door from, selling all those cases of Modelo and Kim Crawford.
Yeah.
But free cash flow, that $1.8 billion, that is what's left over after they've paid to keep the lights on, maintained the breweries, and handled all the basic upkeep.
Exactly.
That almost $2 billion is the war chest. It's the money that gives a company absolute freedom to make strategic choices.
It buys them optionality. And if we connect this to the bigger picture, we see exactly how disciplined they are being with that optionality.
How so?
Well, they maintained their investment-grade credit rating and held their comparable net leverage right at their target of about 3.0x.
To put that leverage target into everyday terms, it's like a household deciding that if they make $100,000 a year, their total mortgage and debt should never exceed $300,000.
That's a great way to put it.
Setting that 3.0x ceiling just ensures they never become so burdened by debt that, a single bad quarter bankrupts them. They're prioritizing safety. It's like a captain steadying a ship in choppy waters by aggressively securing the most valuable cargo first.
Yes, making sure the hull is sound before worrying about how fast they are going.
Exactly.
And they are rewarding their investors for taking the ride with them.
Yeah.
They returned over $1.6 billion to shareholders.
That's huge.
It is. That includes a bump in their quarterly cash dividend to $1.03 per share.
Yeah.
But it also includes $924 million dedicated purely to share repurchases.
The mechanics of a share repurchase are just fascinating when you break them down.
They really are.
If you think of the company's total value as a pizza cut into 8 slices,
Okay, I'm with you.
a A share repurchase is the company buying back 2 of those slices and retiring them.
Right.
So suddenly the pizza is only cut into 6 slices. If you own one of those remaining slices, your individual piece just represents a mathematically larger chunk of the total pie.
Exactly. It's a highly efficient way to reward your investors without triggering the same tax events as, a massive cash dividend.
And that capital allocation strategy tells us everything about management's mindset, right?
Oh, absolutely. They aren't throwing wild, speculative bets at the wall. They are fortifying the castle.
Yeah. It's like a homeowner who gets a massive year-end bonus.
Right.
Instead of immediately taking out a loan to build a flashy swimming pool in the backyard, they use the cash to pay off high-interest credit cards, fix a slow leak in the roof, maybe put some money in their kids' college fund.
They secure the foundation first.
Exactly,
Yeah.
which then buys them the right to think about the long-term future.
Well said. Financial discipline buys you time. And because that disciplined cash flow strategy is keeping the entire enterprise stable, we naturally have to shift our focus to the primary engine generating all that cash,
Ah, yes. The beer segment.
the juggernaut.
Yeah, and this is where the numbers get incredibly nuanced, because the report clearly states that their beer business was the #1 dollar share gainer in all U.S. tracked channels for the fiscal year.
Gaining zero point 0.4 share points.
Right. And furthermore, Modelo Special maintained its absolute dominance as the #1 brand by dollar sales in the entire country.
It is the reigning heavyweight champion of the beverage aisle.
But wait a second, here's where I have to push back on the initial rosy picture.
Okay, go for it.
Because the underlying metrics tell a much more complicated story. While they're gaining total market share, their total fiscal 2026 beer net sales actually decreased by 3%.
Yeah.
And their shipment volume, like the actual physical amount of beer they are putting on trucks and sending out, dropped by 3.8%.
It did.
Furthermore, the report shows that their 2 biggest flagship brands, Modelo Special and Corona Extra, saw their depletions drop by roughly 3% and 7% for the year.
That's right.
So my question is, how on earth does a segment stay on top and gain market share when the absolute heaviest hitters in the portfolio are shipping less volume?
Well, this brings us to the concept of portfolio depth, which is really the secret weapon of any major consumer brand.
Okay.
But first, let's make sure we clarify depletions for you, the listener. It's a piece of industry jargon that simply measures the rate at which the beer is actually being sold by the regional distributors to the local retail stores.
Right, so it's a proxy for consumer demand.
Exactly. Essentially, it's how fast the product is leaving the warehouse to get to the grocery store shelf.
So simply put, fewer cases of Modelo and Corona are moving from the warehouse to the shelf.
Yes. The volume of the Titans slowed down. But Constellation didn't lose its crown because its bench stepped up in a massive compensatory way.
Ah, the secondary brands.
Exactly. Look at their secondary brands, specifically Pacifico and Victoria. For the full fiscal year, Pacifico's depletions grew by over 15%,
Wow.
and Victoria grew by over 16%.
And the momentum shift in the fourth quarter is even more pronounced, right?
Oh, it's huge.
Because in Q4 alone, Pacifico grew by an incredible 21% and Victoria grew by 17%.
Yeah, they absolutely surged.
It seems like Constellation has engineered an ecosystem where they don't actually mind if a consumer gets a little tired of Corona, as long as that consumer migrates to another brand within the Constellation family.
That is the textbook definition of a successful brand ecosystem.
Yeah.
You capture the migrating consumer.
Right.
This explosive growth from the secondary brands is what offset the overall declines in the flagships. And when you isolate that fourth quarter, you see the strategy working.
Because total net sales for beer actually increased by over 1% in Q4.
Exactly. And total depletions eked out a 0.6% growth.
So the rising stars caught the slack, but, volume is only part of the revenue equation.
That's true.
The report also highlights that favorable pricing helped offset the volume declines.
That is the power of a premium brand. Even though they shipped slightly fewer physical cases overall for the year, they possessed enough pricing power to charge slightly more per case.
So consumers were just willing to absorb a small price increase.
Yeah, and that protected Constellation's top-line revenue.
Okay, so in beer, we see them fighting through volume dips with secondary brand growth and strategic price hikes. But top-line revenue is just the money coming in. We have to look at what it actually costs to brew, package, and transport all that liquid. And here's where it gets really interesting, because the cost of doing business right now tells a much more challenging story about the global economy.
We are looking at a classic margin squeeze.
Yeah.
Despite the rising stars and the pricing power, The beer operating margin decreased by 170 basis points for the year, landing at 38.0%.
And just for those not steeped in finance terminology, 170 basis points simply means a drop of 1.7 percentage points.
Right. And if you look exclusively at the fourth quarter, the drop is even steeper.
Oh, yeah.
It's a decrease of 340 basis points, or 3.4 percentage points, dragging the Q4 margin down to 33.2%.
That is a significant contraction in profitability for every single unit sold.
It is, and the report specifically names the culprits behind this squeeze.
Unfavorable fixed cost absorption, increased depreciation, and aluminum tariffs, right?
Exactly.
Let's break down that first one, because unfavorable fixed cost absorption sounds incredibly dense, but the mechanics are actually quite relatable.
They are?
Think about it like running the most popular bakery in your neighborhood. You have a massive commercial kitchen, and your monthly rent is fixed at $10,000.
Right. That rent doesn't change whether you bake 1 cake or 1,000 cakes.
Exactly. Now, let's say last year you baked and sold 10,000 cakes. That means $1 of your fixed rent cost was absorbed by each cake.
Makes sense.
But this year, because of those volume declines we just discussed, you only bake 9,000 cakes. That $10,000 rent still has to be paid, but now it's spread across fewer items.
So suddenly, each cake has to absorb more than $1 of that fixed overhead.
Precisely. Your cost to produce a single cake just went up, which means your profit margin per slice shrinks, even if you sell out of everything you bake.
That is a perfect illustration of the mechanism. Now, stack on top of that bakery the rising cost of raw materials.
Right, the aluminum tariffs.
Yeah. A major beer company is, in many ways, an aluminum logistics company that just happened to put liquid inside the cans.
That's a great way to think about it.
And aluminum is a globally traded commodity subject to geopolitical winds, tariffs, and international trade disputes. When the cost of the raw aluminum spikes due to a tariff, it acts as a direct, unavoidable tax on Constellation's primary packaging.
Because they can't just stop putting beer in cans.
No, they have to eat that cost, which further compresses the margin.
But what's fascinating here is the sheer contradiction in how management is responding to this margin squeeze.
How so?
Well, you would assume, looking at a 3.4 percentage point drop in Q4 margins, that a company would immediately panic, freeze all hiring, and halt all expansion spending.
You would expect them to stop buying new ovens for the bakery, to stick with your analogy.
Exactly. Yet Constellation is doing the exact opposite. They are actively deploying capital to invest in what they call modular brewing capacity.
All right.
I mean, they are forecasting roughly $800 million in capital expenditures for the upcoming year, largely to support future growth in the beer business.
It's a massive investment.
So why double down on building infrastructure when the cost of producing the goods is currently hurting your margins?
What's fascinating here is that in the beverage manufacturing industry, lead times are measured in years, not months.
Okay.
If you wait until the macroeconomic environment is perfect and margins are fully recovered before you break ground on a new brewing facility, you'll be 3 years too late to meet the consumer demand when the market swings back upward.
Oh, I see.
They are playing a long-term game of predictive logistics. They are trusting the structural momentum of brands like Pacifico over the temporary pain of an aluminum tariff.
So in beer, we see them fighting margin pressures by spending $800 million to build more capacity and prepare for the future.
Yes.
But their strategy for the wine and spirits segment is the exact opposite. They aren't building, they are aggressively tearing down.
Yeah, the numbers in the wine and spirits division are, frankly, staggering.
Staggering almost feels like an understatement. I mean, looking at these numbers, wine and spirits net sales plummeted by 51% for the year.
Half their sales.
Yeah. And their shipment volumes decreased by a staggering 62.4%.
Just a complete cliff.
And their operating margins fell off that cliff too, dropping from 19.5% down to a shocking 1.3% for the fiscal year.
It's brutal.
I have to ask this on behalf of anyone looking at this data. How does losing over 60% of your shipping volume actually make strategic sense for a company? On paper, it looks like a total collapse.
It is the most counterintuitive part of the entire earnings report, but it is actually a highly orchestrated restructuring.
Really?
Yeah. This isn't a failure of consumer demand across the board. It is a calculated strategy of addition by subtraction.
Okay, walk us through the math of how shedding 51% of your revenue equates to addition.
You have to look at what specific revenue disappeared. The massive drops in volume in sales are almost entirely driven by deliberate corporate actions.
The divestitures.
Specifically, the 2025 wine divestitures, and the SVA divestiture, Constellation made the hard, proactive choice to sell off massive chunks of their mainstream, lower-tier wine brands.
Along with all the physical facilities and vineyards associated with producing them.
Exactly. To understand the logic, it helps to look at the phrase organic net sales, which pops up a lot in this section of the report.
Right, because when a company talks about organic sales, they are intentionally excluding the mathematical noise of mergers, acquisitions, or in this case, massive divestitures.
Yes. They are saying, if we ignore the brands we just sold to someone else, how did the brands we actually decided to keep perform?
How did they perform?
Well, when you strip away the noise of those massive sell-offs and look exclusively at what they kept their premium portfolio, which includes higher-end brands like Kim Crawford and Robert Mondavi,
Okay.
that remaining core actually outperformed the total wine category in both dollar sales and volume in U.S. tracked channels.
Oh, wow. So they essentially fired their lowest performing, lowest margin products.
That's one way to look at it.
Let's think about the logistics of that. If you sell 100 bottles of cheap wine for a $1 profit each, you make $100.
Right.
But you have to pay for the glass, the shipping, and the warehouse space for 100 heavy bottles.
Which eats into your efficiency.
Exactly. But if you pivot and sell just 10 bottles of premium wine for a $10 profit each, you still make your $100, but your physical logistical footprint is a tiny fraction of what it was.
You've identified the exact mechanism behind the strategy. It is a response to a broader industry trend known as premiumization.
Premiumization.
Yeah. Macro data shows that consumers are generally drinking less wine overall by volume, but when they do choose to open a bottle, they are willing to pay for a higher quality premium product.
Oh, that makes sense.
Constellation just aligned their entire corporate structure with that reality.
So they shrunk the total pie, but the slice they kept is far more lucrative per unit.
Exactly.
But those margins taking a hit down to 1.3%, that is the undeniable pain of the transition.
Oh, absolutely.
Even if you sell off the cheap brands, you still have stranded overhead costs, lingering administrative bloat, and restructuring fees to process before the newly slimmed down division stabilizes.
Exactly. You cannot amputate a massive segment of your legacy business without enduring some short-term financial bleeding. The 1.3% margin is the temporary cost of long-term survival.
Which brings us to the future.
Right.
With the entire portfolio now radically reshaped, leaning heavily on a powerhouse Mexican beer import business and a trimmed-down, highly premium wine segment, how is management forecasting the road ahead for fiscal 2027 and beyond?
Very, very cautiously.
Yeah.
In fact, management took the highly unusual step of withdrawing their previously issued fiscal 2028 outlook entirely.
Wow, that is a massive signal. Wall Street generally hates uncertainty, so for management to proactively take their long-term forecasts right off the table implies they value honesty and flexibility over, artificially propping up near-term expectations with fantasy projections.
They explicitly cited limited near-term visibility as the reason. And their updated fiscal 2027 outlook reflects that profound caution. They are expecting enterprise organic net sales to be anywhere from -1% to +1%.
So essentially, they're guiding for a completely flat revenue growth.
Yes. Comparable EPS guidance is set at $11.20 to $11.90.
Okay.
And they expect beer operating margins to hover between 37% and 38%, while wine and spirits margins are expected to be a very modest 5% to 6% as they work to stabilize that newly divested division.
Management used a very specific phrase in the report to justify this flat guidance: evolving socioeconomic backdrop.
Right.
What does that actually mean in practice for a company trying to sell beverages?
This raises an important question. It means they are acutely aware of inflation fatigue.
Yeah.
It means they are watching the unpredictability of international tariffs that could swing the cost of raw aluminum overnight.
Oh, for sure.
It means they recognize that the average consumer is feeling a squeeze in their wallet, and predicting how that consumer will allocate their discretionary income 12 months from now is nearly impossible.
Right. Because you are committing $800 million to build new brewing capacity, but you cannot guarantee the macroeconomic environment will cooperate when those facilities finally open.
Exactly.
It's like taking your foot off the accelerator because the fog is too thick to see the next turn.
That's a great analogy.
The company is running perfectly, but safety and discipline require slowing down until the road ahead clears. You don't just speed blindly into the fog.
No, you don't. You maintain the dividend, you selectively buy back stock, you fund the critical infrastructure, but you do not overpromise to the market.
That makes total sense.
It is a masterclass in risk management rather than blind growth chasing.
So what does this all mean? If you're listening to this, why does the fiscal 2026 report of a massive beverage conglomerate actually matter to you?
It's a fair question.
I think it ultimately comes down to the mechanics of adaptability. Whether you are an investor analyzing a stock portfolio, running a regional small business, or just someone standing in the grocery aisle trying to decide if you want to buy a 12-pack of Pacifico for the weekend, you are looking at the end result of aggressive corporate evolution. This deep dive reveals how giant corporations survive inflation, absorb supply chain shocks, and navigate shifting consumer tastes.
They don't survive by being stubborn.
Exactly.
Yeah.
They survive by ruthlessly prioritizing what works, like letting the bench players like Pacifico take the lead when Corona slows down, and aggressively, almost painfully, cutting what doesn't.
And that leads me to a final thought, something that goes far beyond the balance sheet and the basis points.
Oh.
Think about the sheer corporate courage it took for Constellation Brands to look at a legacy segment of their identity, the mainstream wine business, and realize it was holding them back.
Yeah, it takes guts.
We are talking about voluntarily taking a 50% short-term hit to revenue, enduring the inevitably bad headlines, and watching their margins temporarily crash to 1%, all to protect the long-term health of the company.
Right.
Look at your own life, your own career, or your own business. What are the mainstream tasks, habits, or projects that are quietly draining your margins and energy without providing real compounding growth?
That's a really good point.
It might look terrifying on paper, but could you benefit from your own personal divestiture?
Wow. Sometimes the only way to ensure the foundation remains strong is to have the courage to tear down the rooms that no longer serve you. Thanks for taking this deep dive with us.